Welcome to the Deep Dive. You're here because you want to get smart fast, right?
Yeah.
Without drowning in data.
Exactly.
So today we're tackling something that hits close to home for pretty much everyone. Household debt and credit. We're going to unpack the latest numbers.
Yep. We're looking at the Federal Reserve Bank of New York's latest quarterly report. This is for Q4 2024, the data they just released back in February.
Right.
Think of it like a financial checkup for American households. We want to see, how people are handling their borrowing.
And our mission today is pretty simple. Cut through the noise, find the really crucial insights in this big report. What's the real story with household finances? How much do we owe? Who's struggling?
And what does it all mean going forward? Because this report, it's really packed.
Yeah.
Oh, yeah. Total debt, different loan types, delinquencies, bankruptcies. It's got national data, state level data. We'll try to keep it clear. Focus on the stuff that really impacts folks.
Okay, sounds good. Let's jump in. The big picture first. How much debt are we actually talking about here?
Okay, so end of 2024, total household debt hit $18.04 trillion.
Wow. 18 trillion.
Yeah, and that was up $93 billion just from the quarter before. That's about a 0.5% increase.
Okay, 0.5% increase in one quarter.
But maybe more striking, that $18 trillion, it's almost $4 trillion higher than right before the pandemic kicked off back in early 2019.
4 trillion higher. That's a massive climb in just a few years.
So where's most of this debt held? Is it still mostly mortgages?
Yes, absolutely. Mortgages are the giant slice, $12.61 trillion. But the non-housing part, that also grew. It went up by $11 billion in that last quarter.
And that non-housing debt, that's things like credit cards, car loans.
Exactly. We saw credit cards jump by $61 billion. That's a pretty big increase.
$61 billion on cards alone.
Yeah. Auto loans were up $11 billion. Student loans ticked up by about $1.6 billion. Interestingly, the other category actually went down a little by $8 billion.
So overall non-housing debt is up, 1.5%? That's right, 1.5% higher than the previous quarter. And that $61 billion jump in credit card debt, that could suggest people are maybe relying more on cards.
Right, for everyday expenses perhaps. So mortgages dominate, but credit cards are where there's a lot of activity right now. How does the overall debt pie look, like percentage-wise?
Well, the report lays it out visually. Mortgages are easily the biggest chunk consistently. Then you've got student loans, then auto loans, and then credit card debt, which includes both regular cards and those home equity lines of credit, HELOCs.
Okay.
And then that smaller other category at the bottom. It gives you a good sense of where the borrowing is concentrated.
And what about just the sheer number of accounts people have? Not the dollar amounts, but how many loans?
Yeah, the report covers that too. And what's really noticeable is just how many credit card accounts there are out there compared to, say, mortgages.
Makes sense. Lots of people have cards, fewer have mortgages.
Exactly. The average mortgage is way bigger, balance-wise, but far more people have credit cards. The report shows trends in the number of accounts over time, too.
Okay, so that's the what and how much.
Yeah.
Now, who's actually taking out new debt? What are we seeing in terms of loan originations?
So for mortgages, the number of new loans actually went up a bit in Q4 compared to Q3.
Oh, interesting.
But here's a little wrinkle. The credit scores for these new mortgage borrowers, they dipped slightly.
Oh, how so?
Well, the score at the 10th percentile, meaning 90% of new borrowers had a better score, that dropped by 6 points. The data suggests maybe a slightly larger share of new mortgages went to borrowers with, let's say, less than perfect credit compared to before.
Okay, so that could mean a few things, right? Maybe lenders are loosening up a tiny bit, or maybe more people with lower scores are trying to buy homes now.
Could be either, or a mix of both. And we see similar breakdowns for auto loan originations by credit score, too. The charts show these trends pretty clearly looking at the scores at origination.
Got it. So a slight shift maybe towards borrowers with lower scores in some areas. Now, the flip side, what happens when people can't pay? How are delinquency rates looking?
They ticked up slightly overall. End of Q4, about 3.6% of all outstanding debt was delinquent. That's up just a hair from 3.5% in Q3.
Okay, small increase.
Yeah, but it's the flow into more serious trouble that's worth watching closely.
What do you mean by flow? Like people going from being a little late to really late?
Exactly. The report tracks balances moving from current to 30 days past due, and then from there into serious delinquency, which they define as 90 days or more past due.
Right.
And for credit cards, cards, we saw a bit of an uptick in early delinquencies becoming serious ones. Also, the rate at which people went straight from being current to seriously delinquent, that edged up for auto loans, credit cards, and HELOCs.
But not mortgages.
Mortgages seemed more stable in that regard, yeah.
Okay, so it really sounds like credit cards and auto loans are the pressure points right now for serious payment problems. What about the actual amount of debt that's seriously delinquent?
Those numbers are definitely climbing. For credit cards, it's now 7.3% of balances that are seriously delinquent.
7.3%.
Wow. And for auto loans, it's 4.6%. Both of those are higher than they were a year prior. That's, a bit of a warning sign.
Yeah, definitely. And what about the really severe outcomes? Bankruptcies, foreclosures.
Well, bankruptcy filings actually dipped slightly in Q4. About 123,000 people had a new bankruptcy noted on their credit report.
Okay, down a bit.
And foreclosures were pretty much flat compared to the previous quarter. Around 41,000 people had a new foreclosure notation.
So even though serious delinquencies are rising for cards and cars, we're not seeing a big spike yet in bankruptcies or foreclosures.
Not in this latest quarter, no. But those rising card and auto loan issues are, like you said, the things to keep a really close eye on.
Let's circle back to housing debt for a second.
Sure. So total housing debt, that's mortgages plus HELOCs, stands at $12.8 trillion. And as we just said, new foreclosures were stable, about 41,000. While mortgage delinquency isn't climbing like the others right now, the sheer size of that $12.8 trillion means even small changes there could be significant down the road.
Absolutely. Now, student loans, that's another big one affecting millions. What's the update there?
Student loan balances outstanding. They increased slightly in Q4.
Okay.
But delinquencies were actually reported as very low. Less than 1% of the total balance was 90-plus days delinquent.
Less than 1%. That seems surprisingly low.
It does, but there's a huge asterisk there. The report explicitly warns that this is likely because the pandemic-era payment pause just ended, missed federal student loan payments. Those are expected to start hitting the credit reports and showing up in these delinquency numbers starting in Q1 2025.
Ah, okay. So that low number is temporary, potentially very temporary. We need to watch that space.
Definitely. It could change the picture quite a bit in the next report.
Right. Okay, back to credit cards and HELOCs. You mentioned balances were rising. What about credit limits? Are people maxing out?
Well, if you look at the gap between total available credit on cards and the actual balances people are carrying, that gap is narrowing.
So people are using up more of their available credit limit on average.
That's what it suggests, yeah.
Okay.
Which fits with the overall rise in credit card balances we talked about.
Makes sense. And this debt that's becoming delinquent,
Yeah.
how is that distributed? Are more debts falling into longer periods of non-payment?
Yes. Looking at the total debt broken down by how late payments are, you see a growing share falling into the 30-60 days late bucket, the 90-plus days late bucket, and what's called severely derogatory.
So the proportion of debt facing real repayment problems is increasing.
Correct. It reinforces that picture of rising stress.
And we keep coming back to credit cards and auto loans. Are they still the main drivers when you look specifically at serious 90-plus day delinquency?
Absolutely. When you break down that 90-plus day delinquency rate by loan type, credit cards and auto loans are clearly showing the biggest jumps compared to mortgages, student loans, or HELOCs. That's where the most immediate strain seems to be.
Okay. And how fast are people falling behind on those specific loan types? Is the transition into delinquency happening quicker for cards and cars?
It appears so. The report looks at the rate at which current balances become 30-plus days late, and then how quickly they move to 90-plus days late. And yeah, for credit cards and auto loans, a higher percentage of current balances are making that transition into delinquency compared to other loan types.
Suggests a faster slide into trouble for those borrowers.
It does seem that way.
But mortgages, you said, were more stable.
Relatively speaking, yes. The transition rates for mortgages going from current to late, or from slightly late to seriously late, are lower.
Okay.
You can see the flows, how many current mortgages become 30, 60 days late, how many of those cash up, how many fall further behind. It's still low compared to historical highs, but obviously something you monitor, especially if the economy weakened.
Right. Always worth watching. What about debt that goes really sour? Debt in collections?
The report tracks that too. It shows the number of people with debt turned over to third-party collectors and the average amount they owe in collections. Gives you a feel for the scale of debt that lenders have essentially charged off.
Okay, let's shift perspective a bit. Who actually holds all this debt? Does it vary much by age?
Oh yeah, definitely. The report slices the data by age group. You can see which generations hold the biggest share of the total debt and how that's changed over time.
And what about the types of debt by age?
Right. They break that down too for Q4 2024. As you'd probably expect, younger adults tend to carry a larger share of student loan debt,
Makes sense.
while older groups, understandably, hold more of the mortgage debt. It shows how credit usage patterns differ across lifetimes.
And new borrowing. Are certain age groups taking out more new car loans or mortgages?
Yes, the report details new auto loan and mortgage originations by age group, so you can see which demographics are currently driving the demand in those markets.
And the tougher side. Delinquencies by age. Are certain groups struggling more?
That's a key question. The report looks at the transition into serious 90-plus day delinquency broken down by age, not just for total debt, but also specifically for mortgages, auto loans, and credit cards.
So you could see, for example, if younger borrowers are having more trouble with, say, auto loans than older borrowers.
Exactly. It helps pinpoint if financial stress is concentrated in particular age brackets for specific types of loans.
And same for foreclosures and bankruptcies, by age.
Yep, they analyze those trends by age group too. Helps identify which demographics might be facing the most acute financial distress.
This is a really detailed national picture.
Yeah.
But you mentioned state-level data, too.
Absolutely. For listeners interested in their specific region, the report has a ton of state-by-state information.
Like what?
Debt per capita, what types of debt are common in that state, delinquency rates, foreclosure rates, bankruptcy rates, it's all broken down. They even highlight trends in specific states like Florida, California, Texas, New York, and others for certain metrics.
So if someone wants to know how their state compares, the info's there.
It is. We won't dig into every state now, but it's definitely worth checking out in the full report if you're curious about local trends.
Okay, so we've covered a lot of ground. Let's try to boil it down. What are the absolute key takeaways from this Q4 2024 report?
Well, the big flashing signals, I think, are those rising delinquency rates for credit cards and auto loans. That's definitely a point of concern.
Even while mortgages are holding steadier.
Right. We also saw overall household debt continue to climb to that new record high, and there were those subtle signs, the slight weakening in credit scores for some new mortgage borrowers.
So for people listening, what's the aha moment? Why does this matter to them?
Well, these trends could potentially ripple out. Rising delinquencies might eventually lead lenders to tighten up credit standards, maybe making loans harder to get. And it also just signals that more households seem to be feeling financial pressure. That could eventually impact consumer spending, which is, a huge driver of the overall economy.
That's a really crucial connection to make. Okay, as we wrap up, what's a final thought or question people should maybe mull over after hearing all this?
I think the big question this report raises, especially with those rising card and auto delinquencies and the looming student loan impact, is why? What are the underlying reasons, maybe in the broader economy, maybe even in our own financial habits, that are driving these shifts?
Yeah, what's behind the numbers?
Exactly. And maybe take a peek at that state-level data for your own area in the report. It might offer some clues closer to home.
Good point. Definitely food for thought. And if you do want to dig deeper, the full report is out there. Where can people find it?
Just search for the quarterly report on household debt and credit on the Federal Reserve Bank of New York's website.
Perfect. It's a valuable resource if you want the full picture.
Absolutely. Hopefully, this deep dive gave everyone a clearer sense of where things stand with household debt and credit right now.
Thanks so much for breaking it all down for us. And thanks to all of you for tuning in to the deep dive. Stay informed, stay curious.
See you next time.